Hello everyone, I am Pratap here. We are at lesson 5, how to trade by using zones. This lesson is having dependency on the earlier lessons. In case if you did not complete the earlier lessons, please go to Neostock YouTube page. There you please click on this home and then scroll down to the playlist supply demand zone price action course. All your earlier lessons and the upcoming lessons will be placed in this playlist. So please go through the earlier lessons before you get into lesson 5. So let's start. How to trade by using zones. Demand zone should be used for long trades. We know demand zone is having institutional pending orders and which can push the price up. That's why we have to go for long trades. Those who are learning stock market concepts first time, probably the word long might be a new term. So let me explain what is long trade or what is long. You brought a share because you know prices will go up. So as per your expectations, prices went up. Now to get the profit, what you do? You will sell the stocks. So in this mechanism, what you did first, you brought. What you did in the next second step, you sold. So that means buying is the first step, and after reaching the target, selling is the second step. Then you get the profit. So first you buy and then you sell, and that mechanism is called long trade. First you buy and then you sell. But when you go for a long trades, if prices are going up, you get profit. In case if prices are going down, what will happen? You get losses. So always remember these two steps. First we are buying and later we are selling. Such kind of trades are called long trades. And next point, supply zone should be used for short trades because we know supply zone is having institutional sell orders and which are having capacity to push the prices down. So what we have to do? You can go for short trades. Again, those who are learning first time, they might not understand what is short or short trades. So let me explain. For a short trade, first you sell the stocks. After reaching your target, you will buy the stocks. Because you know prices are going down. When prices are going down, first you sell and then you buy, you get the profit. It is exactly the reverse of the long trade. Long trade, what you did? First step is the buy. After getting profit, you sell. But in short trade, it is a reverse. What you do? First you sell, and after price go down and reaches your target, what you do? You buy the stock. That way, your trade will be completed. So what will happen in short trades? If prices go down, you get profit. If prices go up, you will get the losses. See, it is exactly reverse of long trade. Long trade, after you buy, if prices go up, you get the profit. If prices go down, you get the losses. But in short trade, if prices go down, you get the profit. If prices go up, you get the losses. So such kind of mechanisms are available. But short trades are available only in derivatives market. Then what about long trade? Long trade is available both in equity market and derivatives market. But here one exception. In equity market, if you want to go for a day trading, that means same day you buy, same day you sell. There it supports both long trade as well as a short trade. That is in equity market for a day trading. But if you want to carry your trade to the next day, in equity market, short trades are not supported. Only long trades are supported. But in derivatives market, you can buy or you can sell on the same day. That means you can go for long trade, you can go for short trade on day trading, or you can carry the positions to the next day in derivatives market. In case if you are not aware of what is equity market and what is derivatives market, please search in the internet. You may find some useful information to understand these concepts in an easy way. But let us limit our discussion to our topic. So let's move on to the main topic: how to trade by using demand zone. So let's focus on this demand zone. It is having proximal line and a distal line. So let's start with our entry. That means where you want to buy the stock. The entry should be the proximal line of the demand zone. This is the place where you need to buy a stock. Why? Because institutional pending buy orders will be there between the proximal line and distal line. So if there are more pending orders at the proximal line, what happens? The prices will be pushed up again from here. So we don't want to miss the trade. That's why when price is about to enter into this zone, so at proximal line, we are defining our entry. That means that is the place where you want to buy your stock. And the next one is stop loss. Our stop loss should be at a distal line of the demand zone, because we know the institutional pending orders are between proximal line and distal line. That is the reason why at distal line we are defining our stop loss. You might ask a question: what could be a stop loss? Stop loss is a price point where you want to exit from the trade when prices are moving against your expectation. So what is our expectation? Once prices enters into this demand zone, the pending orders in this demand zone, the pending institutional pending orders in this demand zone will push the price up. That is our expectation. But unfortunately, what happened? There could be a weak pending orders inside this demand zone, and the existing supply might consume all these pending orders and further push the price down. So that means price is moving against our expectation. When it is about to reach this distal line and about to cross this distal line, it confirmed that all the pending orders in the demand zone are consumed. So that is the reason why we want to limit our loss. Why we want to limit? Because below the demand zone, there won't be any institutional orders. That means price can easily further go down. That means we may get more loss if prices are going down. That's why we want to limit our loss. Because we want to limit our loss, you want to exit out of your trade when prices are going below this distal line. So that is the reason why we defined the distal line as stop loss. So I repeat, stop loss is a price point where you want to exit out of your trade when prices are moving against our expectations. So it's a very important concept. Everyone who is trading in stock market or investing in stock market, they all must implement the concept stop loss. The next parameter is Target. Target is the proximal line of the supply zone, because we know supply zone is having institutional pending sell orders. When prices reaches the supply zone, these pending orders again will push the price down. So we don't want to reduce our profits. That is the reason why we want to book our profit when prices are about to reach into the supply zone. So that is the reason why our target should be proximal line of the supply zone. So these three parameters are very important parameter. In short, we call them as a set. SET, set. S indicates stop loss, S indicates the stop loss, E indicates the entry, and T indicates the target. The beauty of supply demand zone price action theory, it is able to identify all the three parameters in this concept. There are two more important concepts derived by using these three parameters. The first one is risk. Risk indicates the expected loss, and risk is the difference of entry and stop loss. And the second one is reward. Reward indicates the expected profit, and reward is the difference of entry and target. And risk reward is a very important concept in stock market, and risk management is the topmost important concept, and we will be focusing these concepts in detail later in our course. So as a starting point, you are learning the fundamentals or the basics in a simple way. Now the prices reached into the demand zone. That means at proximal line, our entry is triggered. That means our buy signal is triggered. That means it is successful. So we took a long trade. What is long trade? We buy and then we will sell. Where we sell? In the supply zone after it reached our target. That is proximal line. So exactly at the proximal line, we exited our long trade. That means we booked the profit. So this is the way we trade by using demand zone. Let us look into how to trade by using supply zone. If you look into the supply zone, proximal line of the supply zone is the entry. Distal line of the supply zone is the stop loss, and proximal line of the demand zone is the target. It's almost looking similar to the demand zone, but it is reversed here. The parameters are reversed. So proximal line of the supply zone is the entry, distal line of the supply zone is the stop loss, and again proximal line of the demand zone is the target. Now we know what is a risk. The risk is the difference of entry and stop loss. And reward is the difference of entry and target. Now what happened? We got an entry. What kind of entry? Short entry. What we do in short entry? First we will sell the stock. If prices are going down, we get the profit. So our entry is triggered. That means our entry is executed. Now prices are going down and reached the target. So once it reached the target, we will exit out of the short trade. In demand zone, we took long trade, but here in supply zone, we took short trade. That's why we have to exit the short trade. So this is about how to trade by using supply zone. Risk is the expected loss, or we can say potential loss. If you cannot manage this risk, if you cannot manage this risk in the demand zone, or if you cannot manage the risk in the supply zone, the only option is to reduce the risk. How we can reduce the risk? There are several ways or there are several techniques available. And one of the techniques you are learning in this particular chapter is proximal line adjustment or proximal line placement. So you can adjust the proximal line by following certain rules. So let us focus on those rules. In order to manage the risk, three methods are defined for proximal line placement for demand zone. Method 1 is proximal line should be placed at highest wick of the base candles. Proximal line should be placed at the highest wick of the base candles. You know, highest wick always refers to zone high, demand zone high. So that is what we have already seen. And method 2, proximal line should be placed at the highest body of the base candles. It is the highest body of the base candles. And it is the most preferred method. Or we can say it is the recommended method. And method 3 says proximal line should be placed at the lowest body of the candles. So let us look into these three methods in detail. Please look into this chart. And we place the proximal line as per the method 1. What method 1 says? Proximal line should be placed at the highest wick of the base candles. What is the highest wick? This first base candles wick is the highest. There we can draw the proximal line, and it is also at the zone high. We have already seen this example earlier, but let us discuss in order to compare with other methods. And what is the risk? It is the difference of entry and stop loss. So in this method, the risk is at the maximum. Why the risk is at the maximum? You will understand once you look into method 2 and method 3. And this is the reward. We already learned reward is target minus entry, or the difference of entry and target. Now price reached the demand zone, so our entry is executed. Because we placed our entry exactly at the proximal line, and already price reached this proximal line, so definitely our trade would be executed. This is one point we should observe. Let us look into second method. What is the second method is saying? It is the highest body of the base candles. Proximal line should be placed at the highest body of the base candles. What is the highest body among these three candles? The first candle is having highest body. So instead of placing the proximal line at the candle high, now we can change to candle highest body as per this method. So now we have changed the proximal line. So now this proximal line at highest body is going to be our entry, and the stop loss remains same. But what is the change we can observe here? The risk is now reduced compared to the method 1. Now this is the new risk. It's a minimized risk compared to the method 1. But we got another advantage also. What is that? Our reward is also increased. Now look into the reward. Because the proximal line is changed, now the reward is calculated from method 2 proximal line. So our reward is also increased. This is one advantage of changing the proximal line to method 2 instead of method 1. Now prices are reached into the demand zone, and definitely at this method our price would have been executed because price already crossed this proximal line. So this is one observation you should make regarding the proximal line placement for method 2. Now let us look into proximal line placement for method 3. What method 3 is saying? The proximal line should be placed at the lowest body of the base candles. Proximal line should be placed at the lowest body of the base candles. So among these 3 candles, which candle is having the lowest body? The second candle. So we are drawing our proximal line as per the method 2. And this is going to be the entry. Now what about the risk? Now the risk is minimized. And what about the reward? Now reward is increased because of that. The moment your risk minimizes, your reward will be increased. That is another advantage we get. Is it not amazing? Yes, it looks like amazing, but we have a problem here. What is the problem? Entry. Did the price reach the proximal line? No. The prices reached up to this level, and the pending orders, institutional pending demand orders, or we can say institutional pending buy orders, pushed the price up. So our price did not reach unto the proximal line. So this is one major disadvantage. We have higher chances of missing the entry. Our trade may not be executed here. So this is the disadvantage of choosing method 3, but the advantage is risk will be minimized at the maximum extent and you will get the best reward. But at the same time, your trade orders may not be executed. So you have that risk. So these are all different ways how you can manage the risk. These are the 3 different ways how you can manage the risk. Now let us look into proximal line placement for supply zone. And the proximal line placement rules for the supply zone is different compared to the demand zone. They are looking similar, but they are different because of difference in the zone. So it is also having 3 methods. Method 1 says the lowest wick of the base candles. Proximal line should be placed at the lowest wick of the base candles. And method 2 says proximal line should be placed at the lowest body of the base candles. And it is the preferred method. We can also say recommended method. And method 3 says highest body of the base candles. So these are the three methods. So let us look into the charts for all these three scenarios. So what is the method 1? Proximal line should be placed at the lowest wick of the base candles. So this is the first candle is having the lowest wick. That is nothing but the supply zone low. We have already seen this scenario earlier. And what about the risk? It is the difference of entry and stop loss. So in method 1, always the risk will be maximum. If you want to minimize the risk, you should look for the other methods. But here maximum risk is there. That is one disadvantage. And reward is also less compared to the other methods. But the advantage is we have higher chances of executing our trade orders. So in this example, the trade is executed because price crossed the proximal line. And let us look into the method 2. What is the method 2? Which is the lowest body of the base candles for the supply zone. Proximal line should be placed at the lowest body of the base candles. So let us draw the proximal line as per the method 2. So this new proximal line is our entry. Now what is the risk? The new entry minus stop loss. That is the difference of stop loss and the new entry. So now is the risk minimized now compared to the previous method? Yes, risk is minimized. At the same time, our reward is also increased. And if we want to further reduce the risk, we should look for method 3. But before that, is the price executed as per this example? Yes. Method 2, our order is executed. But what is the disadvantage of method 2? Sometimes the price may not reach this proximal line. Even just before reaching the proximal line, it may turn back and then the price may go down. So that possibility is there. So this is one disadvantage compared to the method 1. But this is the most preferred method because majority of the trades will reach this method 2 proximal line. That's why it is a preferred method. But there could be few scenarios. Price may not reach up to this method 2 proximal line. Now let us look into the method 3 of supply zone proximal line placement. What is the method 3? It is the highest body of the base candles. Proximal line should be placed at the highest body of the base candles. So let us draw the proximal line. This is the new proximal line and this is going to be our new entry. Now our stop loss, our risk will be calculated as per this new entry and the existing stop loss. See, now the risk is very minimal. But reward is the maximum reward. But what is the problem? The price may not reach until this method 3 proximal line. The reason is the pending orders in this zone, the pending sell orders in this zone might push the price down before the price enters into the proximal line. That is what happened here. So our trade is at this line, but price did not reach. Our trade is not executed. So we have higher chances of missing the trade by choosing the method 3. When you have to choose method 3, If you cannot bear the risk at method 1 or at method 2, then only you should go for method 3. So these are the different ways we can manage the risk by changing the proximal line placement. So always you have to remember there are 3 methods, method 1, method 2 and method 3. We always say the technical names method 1, method 2, method 3. So the meaning of what is method 1, method 2, method 3 you should remember for demand zone and also supply zone. The rules for demand zone are different, the rules for supply zone are different. So you should go through these rules until you memorize them. You have to remember them because this is the most important topic, because your risk management is based on these rules. That's why you must memorize. If you cannot memorize, repeat the video second time, or there is nothing wrong in repeating this video even third time. It's worth listening because they are important. Now let's discuss about risk reward. Risk indicates the expected loss, or we can also say the potential loss. The formula for risk is absolute of entry minus stop loss. Absolute always returns the positive value. Those who are not having idea about this absolute method, please refer part 2 of our first video for candle body. I clearly explained the absolute method with examples. Don't miss it in case if you don't have idea about the absolute. You have to refer part 2 of our first lesson. And reward indicates expected profit. We can also say the potential profit. So what is the formula for reward? It is absolute of entry minus target. Then what is risk reward? Simple, risk by reward. You will be getting risk reward, that is RR. Risk by reward ratio. It indicates the number of times we can get the profit compared to the loss. Examples are something like 1:3 or 1:5 or 1:2.5, 1:8 or 1:3.5, something like that. What is this 1 and what is this 3? For one risk, 3 times reward we get. For example, if your risk is 10 rupees, so you get 3 times reward. 10 into 3, that is 30 rupees reward you get. That means if you get a loss of 10 rupees in a particular trade, if it failed, but if it is successful, you get 30 rupees profit. That is 3 times more than the risk. That is what the meaning of 1:3. What is the meaning of 1:5? It is 5 times more than the risk. You get the reward. That is what the meaning of 1:5. And 1:2.5 meaning is you get 2.5 times more than the risk. And 1:8, if rupees 10 is your risk, and 10 into 8, that is 80 rupees profit you get. Your potential risk could be 10, but your potential reward is 80 rupees. That is what the meaning of 1:8. But most of the times you will be seeing 1:3 risk reward trades in supply demand zone, between the supply and demand zones. Sometimes even you get 1:5 risk rewards. If you are a beginner and if you are learning these concepts first time, And probably you can focus on 1:5 risk reward related trades. They could be more safest. Anyway, we will understand these concepts in detail once we look into the examples. So it is also called risk ratio reward, or risk is to reward, like 1:3. So one indicates in 1:3, one indicates the risk and 3 indicates the reward. That's why risk is to reward. And in short form, we call it as RR. That is risk reward. Let us look into the examples to understand risk reward calculation in a better way. Example 1 of risk reward calculation. Let us look into the demand zone. So we would like to take a trade on this demand zone based on method 1 proximal line placement. What is demand zones method 1 proximal line describes? The proximal line should be placed at the highest wick of the demand zone. So what is the highest wick among these 3 base candles? That is zone high. So this is going to be our proximal line. So proximal line describes the entry. Let us assume the entry is Indian rupees 100. So what about our stop loss? Stop loss should be the distal line of the demand zone. So let us draw the stop loss. This is the distal line. So let us assume the stop loss is Indian rupees 98. Now what is the risk? Risk is the difference of entry and stop loss. That is 100 minus 98, which is going to be rupees 2. So our risk is rupees 2. So what exactly the meaning of risk equals to rupees 2? It indicates a potential loss if the trade is against to us. We are in a position to lose rupees 2 for every 100 rupees share. If the capital is 100, you are in a position to accept this risk. So what is the percentage? The rupees 2 in 100 rupees is, it is a 2%. That means if the trade goes against you, you are in a position to accept a 2% loss from your capital. So this is how you need to understand the risk. Okay, if our trade is in our favor, then what is our reward? So you have to calculate your reward based on the target. What is your target? That is the proximal line of the supply zone. Always method 1 proximal line of the supply zone. So this is your target. Let us say the target value is rupees 106. So now what is our reward? Reward is the difference of target and entry. That is 106 minus 100. That is rupees 6 is your reward. So reward equals to rupees 6. That means for one share of your trade, you are going to get a reward of rupees 6. So which is going to be 6% of your capital. That means you are expecting a profit of rupees 6. That is 6% of your capital. So if the trade is against you, you are willing to accept a 2% loss. If the trade is in your favor, you are willing to take a 6% reward. So that is the reason why we can calculate our RR as 2:6. For 2 rupees risk, you are expecting a 6 rupees reward. So always we calculate reward with 1:2 based. So that's why RR equals to 1:6 divided by 2. That equals to 1:3. So what this RR indicates, for every 1 rupee loss, you get a 3 rupees profit. In other terms, for every 1 rupee risk, you are expecting a reward of 3 rupees. So this is the real meaning of 1:3 RR. That is risk reward. So let us look into one more example to understand this concept in a much better way. The risk rupees 2 is a little higher than our risk handling capacity. Because the risk is higher than our risk handling capacity, can we accept this trade? No, we cannot accept this trade. So then what is the solution? The solution is to reduce the risk by altering the proximal line placement that we will analyze in our next example. In this example, let us reduce the risk based on the method to proximal line adjustment. So what is a method to proximal line adjustment? It is the highest body among the base candles. We have 3 base candles. Which base candle is having the highest body? The first candle is having the highest body. So let us draw the proximal line at highest body of this base candle. So this is our new proximal line. Because the proximal line is changed, the entry is also changed. Assume at this level, the price is 99.5 rupees instead of 100 rupees. Because you changed this entry, your risk also will be changed. For that, you need to calculate by using entry and stop loss. That is 99.5 minus 98, that is your risk equals to rupees 1.5. So now if I am taking 1000 shares, what is going to be my risk? It is now 1500. Earlier it was 2000 rupees. Now it is only 1500 rupees. Your risk is reduced. Not only risk is reduced, now your reward is also increased now. Your target still remains 106 only. But your reward will be changed. It is 106 minus 99.5. So you got a 6.5 is the reward now you got. That means your profit is going to be 6,500. If you get a loss, it is only 1,500, but your profit will going to be 6,500. Just because we adjusted the proximal line placement, we got a better result. Sometimes there is a possibility that your trade may not be executed in this line. The price will come down and just reach this zone high, and a little below it will go, and then again it will turn up. At the time, your trade may not be executed. But we already land in method 2. It is the most preferred one or recommended one, because at least maximum trades will be reaching up to this proximal line. So now what is the RR? RR equals to 1.5 is to 6.5. That equals to 1 is to 6.5 divided by 1.5. That equals to 1 is to 4.3. So for every one risk, you get 4.3 reward. This is what the meaning of risk reward for this particular example. So let us look into one more example, but this time let us look into the supply zone related example. Now let us take a trade from the supply zone based on method 2. What is method 2 for a supply zone? It is the lowest value of, lowest body of the base candles. Lowest body. What is the lowest body? The first candle in this base candle is having the lowest body. So let us draw the proximal line. So let us assume the value here is 106.5. This is going to be your entry. What is your stop loss? That is the distal line, that is 107.5. And what is the target? That is demand zone high. So here risk equals to 1, that is 107.5 minus 106.5, that equals to 1. And your reward, to calculate the reward, your target is 100. That is this demand zone high. So the difference of target and entry is going to be your reward. That is 106.5 minus 100, that equals to 6.5. So what is risk? 1. Reward 6.5. What is the RR? 1 is to 6.5 is the RR. For every one risk, you get 6.5 times reward. Assume if you buy 1,000 shares, a buy means this is a short trade, right? If you short, because supply zone we have to go for short trade. If you short at the supply zone, and for every 1,000 stocks you sold here, you get 6.5. That means if you get a loss, it is going to be 1,000, and if you get a profit, it is going to be 6,500 rupees. Due to any reason, if your trade failed in the supply zone, you get 1,000 rupees loss. You have to prepare for that. If you feel 1,000 is a reasonable, you can take that risk and you can enter the trade. And if your trade is successful, what happens? You get 6,500 rupees profit. This is how we calculate the risk and the reward. Let us look into this risk reward into more details in the coming days. But this concept is very important, and you should seriously focus on risk reward. Basically, the fundamentals of the risk management, you should seriously focus at this stage. And if you are having any confusion, please go through the video. There is nothing wrong in repeating the video second time or even third time. I clearly told you sometime before, risk management is the top most important concept. Many people get losses in stock market because they don't properly manage the risk. That is one fundamental reason. But the beauty of the system is the supply demand zone price action system is it is having all these concepts inbuilt within this theory itself. I already told you SET, S-E-T, stop loss, entry and target. And they are clearly telling you what is your risk before you take the trade. If the risk is not manageable and the risk is not within your managing limit, you need not accept the trade. You can look for some other stock. Such kind of system is not available in any other technical analysis concepts. Because last 21 years, I have seen several systems in the stock market. No system is having all these integrated concepts. People develop some concepts, bringing one concept, a risk-related concept from based on one concept, reward-related concept based on another concept. Both are not related to each other, but they were trying to correlate non-related things. Obviously, when you are trying to correlate non-related things, that doesn't work. But supply and demand zone price action is not like that. Everything is there inside this concept. They are related. When they are related, obviously your concept works in 100% perfect manner. And this concept is going to tell you in advance. Before taking the trade itself, it is going to, before taking the trade itself, it is going to tell you. If you take this trade, in case if the trade is against you, this is what going to be your loss. That is what risk. It is also telling you, if the trade is in your favor, this is what your reward. That is nothing but our profit. In case if you feel the risk is high, you can adjust the risk by using digital line placement. That is what this concept is clearly explaining us. Of course, some more concepts also you will be learning in the second phase of this training program. Those concepts will also tell you how to further reduce the risk. So all these concepts will make your system much more robust compared to any other technical analysis concepts. Because I did a lot of analysis related work, I did a lot of research, I developed so many algorithms, and finally I realized this is the best concept. That's why this course is a highly expensive training program. If anybody is attending this training program without doing any research, you may not be knowing the real value of this training program. There are some people charging over 2 lakhs Indian rupees for providing training on this demand and supply zones. But you got an opportunity to learn. So try to utilize this opportunity. Don't mind to repeat the video second time or third time, because everything is there in this presentation with clear examples for every scenario I have described. Go through them. Go in a slow manner. But go through each and every point clearly. Then this system will give you the maximum comfort for your trading management point of view. So I feel this is a very important video for every demand and supply zone trader. You not only learned demand and supply zones, but now you also learned the risk management related concepts, especially SET. There is one more S is there that you will be learning in the second phase. So during that time, once again, we will look into these concepts. By that time, you get some comfort in using this system. But the reason why we discussed these concepts a little early, because you have to practice a lot before you get into the real trading. I hope you guys are understanding how important these concepts are, how much seriousness you should be while learning. So this is about today's session. In the next session, I will be focusing on gap theory, zone strength, and the base candle count. If you have any questions, please mention them in the comment section. I will try to answer as many as possible. Let us all meet again in our next video.